With the Australian share market up over the past few weeks, the ASX 200 has been up 10% in just 3 weeks. And with a kick-along given by the interest rate cut last week, is there still value in equities? For his view, Mark Christensen, investment analyst at Pengana Australian Equities Fund, joins us now. Mark Christensen, thanks very much for being with us.
Hi, Helen.
Now, in general, in equities at the moment, are you wary at all? I mean, we've had this rise, the interest rate gave it a kick along. Are you wary, or are you taking advantage of this booming market, I'll call it?
That's probably fair to say. Look, at Pengana we tend to focus more on absolute return rather than relative, so we find ourselves spending less time on focusing what the market is doing and more time employing procedures to pick stock-specific opportunities. If we can't find those opportunities, then we essentially retain cash. Now, it's fair to say we've been selling more shares lately than we have been buying them, and our cash holding in the portfolio is now a little bit over 25%, which is quite a high level, about as high as it has been in the 6 years life of the fund.
Yeah, no, that's quite high, Mark. And so you said you're doing more selling than buying. So does that mean you think there are risks in the sort of market that we've got now?
Yeah, look, mainly valuation risk, to be honest with you. Earnings expectations have become a lot more measured. We have reasonably stringent disciplines when it comes to sort of when we hold and when we sell shares. And as you mentioned before, the stock market has been very strong. So we have found ourselves taking profits, which is a nice position to be in. But when it comes to actually finding a place to put that cash back into the market, you know, incrementally fresh money today, it is a bit more challenging. I guess our view, as I said, our absolute view is if we don't have to invest, we won't. We don't think investing in the market when it's very high, having an active view that there is earnings risk is necessarily the right thing for our investors. So
yeah, but that's so interesting, because I mean, if it's in cash, do you get a better rate than retirees down at the bank, which isn't very high at the moment?
Oh, look, we work on that for sure, and we don't have it stashed in pillows, but at the same time we are obviously invested in the other 74% of the portfolio, and we're pleased that has meant performance this year has still been very strong. So we're still able to generate a very good return for our investors, even though we are holding that. What it does do is it gives us a good position should we actually see a correction in the market, and
Sure.
this has happened over the last 6 months, when you know, the corrections do occur. It means we're well placed to be able to capitalise on stocks that we look at now we'd like to own, but it's just too expensive. So some powder dry, I guess you could say, but it is a bit challenging in this environment. I mean, you mentioned at the outset, the stock market is up 10% in the last 3 weeks alone, albeit that is off maybe a depressed base before Christmas, but the ASX ex-financials is now trading above 18 times forward earnings, which is a very high number. And I guess I'd point out the last time it was trading at those levels was just pre the GFC, just prior to GFC. And if I look in the last 15, 20 years, it's really only traded at these levels 2 or 3 times. So we do think there are stock-specific opportunities.
All right, just before we get to those, does this also mean you're thinking there will be a correction, or is there still a lot more to run in this market?
Well, I mean, look, it's, as I said, we try to focus our skills on picking stocks as opposed to taking a view on what overall markets will do. But certainly, lower interest rates is a catalyst for higher asset prices. You know, that's without doubt. We also have a unique market where we have a lot of pension inflows coming in, and you know, versus the size of the equity market, you know, there is that sort of ongoing structural support. So for sure, there's nothing that, you know, an argument could certainly be made that momentum could continue. We would just highlight that the risk of participating at these levels, particularly entering at these levels, is higher than it might have been a few months ago, and that is something that we do pay attention to.
So you're saying there is still value to be had, in your view. Now, where is it?
Well, I just sort of say I'm not sure that we see value across the board. I guess my comment was more that there are factors which could continue to support the market.
Right, but it's not all doom and gloom?
Not necessarily all doom and gloom. That there are pockets of the economy which we think are pretty well placed in the near term. Three come to mind, I guess. The first, I would say, is the tourism sector. The weaker Australian dollar has meant that companies exposed to outbound tourism have suffered. Flight Centre's share price, at least, is an example of that. But I'd suggest that companies exposed to inbound tourism should be a beneficiary of the Australian dollar in the near term, as Australia becomes a more attractive place for tourists, international tourists, to visit.
Yeah, the other two areas?
The other two areas, I would say New South Wales as a regional pocket. The economy in New South Wales held up pretty well. Victoria is an example that has struggled for reasons that your listeners are probably quite familiar with, and so we think companies that have disproportionate exposure to New South Wales will also be pretty well placed.
Okay, and there was a third?
The final one, I would say, I would caveat up front by saying I'm not particularly bullish on the consumer per se, but there's no doubt that falling petrol prices together with last week's interest rate cut will deliver effectively 2 to 3 interest rate cuts to consumers all at one go, and that means categories exposed to small discretionary spend such as wagering or retail exposed to the C&D demographics, they should benefit from that near-term tailwind.
Okay, so a couple of companies that you're quite liking in either retail or gaming?
Yeah, so look, the gaming sector gives you a pretty good chance to play all of those pockets. Crown Resorts is a good, attractively valued inbound tourism beneficiary, I think. The likes of Tats Group will benefit from people buying more scratchies at the counter and perhaps a little bit more wagering. And if you want the New South Wales exposure, Tabcorp's a good option there with a large New South Wales facing business. On the retail side, I'd actually suggest Super Retail Group is a name that we do quite like. It has a customer demographic quite exposed to the C&D levels, together with a number of self-help initiatives that management has in place and frankly some easy comparisons over the next 6 months at least. I think that's pretty well placed. There's a very large short base in those shares, and I think if they just report reasonable earnings, then the shares will probably be fairly well supported. All right, Mark Christensen, great to talk to you. Thanks for coming on. Thank you very much.
And coming up, Aki's
belonged to Madonna yesterday in her interesting outfit choice. The 56-year-old mother of four strolled the red carpet in a pushed-up corset, fishnets and thigh-high boots, flashing photographers on her way past. She then took to the stage for a raunchy performance, simulating sex with her backup dancers. Look, critics have slammed